Hey guys, I appreciate y'all for being here. This is my first on ever members video. I'm going to make it for members of the Discord. Jax, you want to come say hi? You want to come say hi? Make it for members of the Discord. Well, hello there. Okay. Anyway, if I can figure out how to do that. Okay, I want to try to do a little better job explaining the three-legged option strategy, the loaded dice, whatever. The thing is, I'm not doing a good job, but I'm trying to explain the theory of it. I don't want to just share the trade and have you guys copy it. I'm hoping to that somebody will understand why you would want to do this trade, because you may not want to always do this trade. You have to, I'm showing you how the math works out, but there may be, you have to make considerations as far as your own account, as far as your own information goes. For one thing, how big of a trading account do you have? And for another thing, what do you think about the whatever stock it is I'm talking about? Because you can bet I haven't looked at the stock. I'm just looking at the math of the deal. So, but if you guys can help me look at the stock, then we can maybe try to put something together, or, pick a good stock or something. Okay. I just want to do some basic stuff here. Okay. Well, first of all, I want to show, I did just make this, there's a thing called a risk reversal. It's a very old, tried and true thing. They have a Chicago Board of Option Exchange has an index where they track how much money you would have made if you had done it since the beginning of time, since the 1990, and on $100 it'd be worth $1,700 now. It's just like the covered calls or the short put index. So they make a lot of money. They're solid money makers. It's a solid strategy. All a risk reversal is this. This is the index, but I just pulled up the supporting documentation. All they do is they have a long call and a short put. They're at the money. I don't think they say at the money there, but well, actually not. They aren't at the money. They're 25 delta. Okay. But anyway, that's fine. So they have a long call and a long put, and that is their risk reversal. Okay. That's the same thing I'm showing you guys how to do basically in, it's a very similar thing to what I'm trying to show you guys how to do with the loaded dice. The loaded dice is a form of a risk reversal because you're selling a put. You have a short put. The short put is financing the long call. In the case of what I'm showing you guys with three legs, you have two puts because you have a put to cap your maximum loss, but you don't have to. But anyway, that's neither here nor there. But it's a very old, tried and true strategy. Hedge funds and banks have been doing it since forever, and it basically it replicates stock. And here's the clue. See this where it says T-bills. Thing is, it doesn't. You can control the same amount of stock you could with a lot bigger pile of money. So a bank could do this to control. Say if they had $500 million of SPY or IVV or indexes or whatever. They could use this. They could buy the equivalent number of calls and sell the equivalent number of puts to equal the shares. And you could do it for a whole heck of a lot less money because of margin and because options have a leverage component. And anyway, the balance you put in T-bills. So the index is constructed of how well the T-bills do. Plus this is still just a long stock position. It does well when the market goes up. So it's like anything else. And that's how my trade is. That's how the loaded dice is. It does well when the market goes up. Okay. But anyway, that's the theory of it. I'll show you how to do it in TastyTrade also, but let's look at bar chart. Okay, well, bar chart, I just pulled today's highest odds. I don't like these ones that go out till 2026 or whatever. I mean, so, and I don't know how to filter for two things at once. But anyway, the ones that expire, this month or at least early, mid next month, we have STEM, STEM. It's only 88 cents. The ones that are too cheap, I ignore. I like the ones that are about $10. That's how there's this quantum one. Or it's a quantum one. It's QUBT. Now I heard quantum's no good anymore because Jensen Huang said the NVIDIA is not going to use it, and so they've been selling off quantum. Well, maybe we look at maybe we look at constructing a bearish loaded dice on this one. We were going to look at a bearish loaded dice on a stock called PBR that was recommended by one of the Discord members, but it doesn't have enough liquidity. It is a bad stock, but its options don't have enough liquidity. I had it pulled up, but anyway. All right, so for now, we're going to show two things. I want to show how to construct a bearish loaded dice, but then I also want to show how to construct a bullish loaded dice. And on the bullish loaded dice, we aren't going to choose a bad company. I'm going to show you can do it in anything. We'll go do it in Facebook or Apple or something legit. I'll show you how to do a bullish strategy. It could be on anything, but for this one, it would have been better to do this bearish strategy yesterday before the big drop, granted, but QUBT. So I'm going to get into option strat. That's running real slow. We'll get into option strat, Q, and then we'll get back into there, and then we'll look into TastyTrade, and we'll make sure option strat is giving us the right prices. Make sure option strat is realistic. All right, so let's say we were bearish on this one. So the other one we start with selling a put. So this one we're going to start with selling an at the money call. So this right here is a long call. We would have to switch this to -1. So -1 means sell to open. Okay, that's the start. That's the base of our bearish, three-legged bearish trade. Then we're going to want to buy a call that's out of the money. Just like in the other one, we buy a put to cap our max loss, but because this is opposite, we're going to buy a call. So we'll go 5 points out of the money. So that caps our max exposure at $500. At $500 less the credits you receive. Now the credit, the difference between these two is $76. So this doesn't look like a great deal by itself. I didn't really like that deal by itself, but it's a starting place. Has a 61% chance of profit. It's a bet that the stock doesn't go up. If you guys don't think quantum's going up, if it's dead money or whatever, it's a bet that it doesn't go up. So then at the same time, to make the third leg, we're going to hit add. And on the third leg of the other one's a buy call, but this is a buy put. Okay. And for now, I'm just going to throw it down there and just leave it there. It's fine for now. So that's not a bad looking trade, but right there, there's a trade you can do. Now, what I want to do is load the dice a little bit more. The reason I call it loaded dice is because a normal option trade or a normal stock trade should just be 50-50. I mean, it is 50-50. And if you buy in at the money option, that's basically a 50-50 bet. The loaded dice trade, I try to make the odds where you have as much buffer in break even possible. So what I'm going to do is I'm going to try to slide this back a little bit. In other words, make a higher percent chance of profit. I'm going to slide it back to 11. So now we're going to sell the 11 and buy the 15. We're just looking at it. So I'd like to scoot this as far out as possible. The farther out I can scoot it, the bigger buffer I have. Okay. But when I scoot it that far out, it's only leaving $9. It's not enough money left over for me. It looks like 11. It looks like this kind of might be the edge of where it's smart to scoot it out to. But anyway, that's a 69%. That's why it's loaded dice. You're going to win 7 times out of 10. Okay, now let's talk about the three-legged component. The third three-legged component in the bullish one is just to give you some upside you can dream about. You aren't dreaming about this one going to 0. Let's drop the third leg. So I'm trying to teach you guys, it's not always the best. The three-legged spread is not always the best way to do it. Sometimes you might just want to do 2 legs. Let's exclude it. Let's just go for that. Let's go for, let's just do something like, we could make 10% right there today And all it has to do by the end of the week is not go up 15%. This expires in 2 days. Okay, and you make 10%. That's if you want to move it out till next week. Let's move it out till next week and see if we can move, and let's try to load the dice a little bit more. Let's try to get a 75%er. Yeah, there's a 75%er. I don't like to lose. I don't like risk. So I'm trying to show you guys how to do the same thing, whether it's a 2-legged spread, a 3-legged spread. This is still just a way to make, right now I'm showing you a way to make a bearish bet on a stock. So what's making this work is we're selling calls. So when you buy a call, you're bullish, right? So we're finding somebody that's bullish on this, and they're paying too much. Look, this call is 207% IV, bid at 50, asked at 60. They're paying way too much. So we're like, okay, we'll take that bet. So we take their $50 from them. But then we don't want to get stuck if the thing does go up. So then we buy this 16.5 for 15 cents. We end up making the difference. You see how that works? It's an income trade, but at the same time, we're trying to make the distance. Look, this has to move 30% to beat us in like 9 days. Okay, but the problem is you only make $31 on $369 risk. It's a little bit less than 10%. I personally don't do these unless there's about 10% reward in it for me, but sometimes you have to scoot the stock too close to make the 10% reward. You have to scoot the strike too close. Okay, but that right there makes 10%. So I'm going to say that right there is a way to play a stock that you think's dead money. That's one way to do it. Okay, and I'm sorry that's not the 3-legged spread, and I showed that I would do the 3-legged spread, but just we're going to use our brain to do the 3-legged spread really doesn't help us that much, because I don't really think this. I don't want unlimited downside to zero on this thing. I'm not that bearish. So we're just 2 legs. We're going to sell a call spread. Okay. Okay, now I like to play devil's advocate because I'm just trying to teach the theory of this. I'm not teaching you guys how to do this. I want to teach you guys a theory, and then you guys find a stock and you're like, okay, yeah, I think this could work on that stock. Yeah, because these puts are stupid expensive. Let's say if you're bullish on this stock, just to play devil's advocate, I'm just going to show how to do a bullish trade. So we're gonna we can just hit switch to put. Our 2 calls, I'll just hit switch to put. Okay, so where we start, we always start with selling. When we're bullish, we start with selling puts. Okay, so we start with selling the at the money put. So that means selling the 10 put. And then we buy a put somewhere down below it somewhere. Okay. So this would be the start, or the first 2 legs. This would be the base of the 3-legged loaded dice trade. So we're starting off with the 66% profit of a bullish one, and we made a buffer of 14%. In other words, market has to move 14% against us. This thing's already gapped out, so it has to move another 14% to beat you. And of course, if it moves, you can lose that much total. But anyway, so that's fine. So now we're going to hit add call, because on something like this, sometimes it is nice to have some upside. So we go out about 5 strikes. On option strat, what I do is right there at that first hash mark, that's the first standard deviation, and the market gets to that hash mark about if it moves up, that's about 80% of the time it gets there. That means about 20% of the time it moves past it. Yeah, I don't want to put this too far out here where there's no chance. That's like a 5 standard deviation move. You don't want to put it so far out there, even though you get a higher credit. You want to move it as far in as you can without messing up your credit. Right here, you get an $84 credit on $400 risk. You have a buffer of 11%. And I'm going to move the strike where it's closer, right on the first standard deviation, where you have some chance of upside. Okay. So something like that, $69 credit on 400. So I like this trade, just the math of it. I don't know anything about the stock. I like the math of it better than the last one I showed you, which was the opposite bet. Okay. So we'll just save both trades and see how they work out. But it doesn't matter if you're bullish or bearish. You can do it in either way. The reason the math works out better is because stocks like this have a lot of call skew, tons of call skew. And it also works its way into the puts. But you have that it makes these stocks so rewarding. The selling at the money put is so rewarding. It's more rewarding than selling the at the money call. So the math, and I'm talking the math of it is. So now look at this. You don't have to do a three-legged spread. You don't have to do anything. You could also, sometimes it's the right thing to do, even if you're bullish, to leave the upside off and just to do that. So what you're doing here, you're selling it at the money put, $1.40. This is just a put spread, and you're buying protection at 15 cents. Most you can lose is $500 because that's the difference between the strikes, less the credit, 126. So your max loss is 374. Easy peasy. There's even sometimes where you might want to not even do the put. This thing can only go to zero. You don't have to do a spread. Now your risk is $1,000 less the credits you received. You received $143 credit. So now the risk is $857. But if you really aren't worried about it dropping to zero or something, sometimes it doesn't make sense to do the put. That's what I'm saying. You're the consumer on these, and I construct these things one step at a time and look at them. So this is the first level. You could just do that by itself, and that's a great trade. I mean, there's nothing wrong with that. If you want a little bit less risk, you can include the bot put, which changes it into a put spread. All right. If you want everything all at once, you can do the max spread or the whatever, and you can add in a little upside. Now you get less credit, but then you have a chance at some upside. Anyway, I like all of these trades in different situations. So anyway, we'll just save this trade. I know that's not, you guys are bearish on quantum, but I'm just saying that the math of this one is good. Wonder if it bounces back. This is a quantum YOLO, basically. Now let me show you, well, I'm not going to show you. I could do this all day long, but let's talk now. I want to concentrate more on the theory of these and why you would want to do these and when you don't. So let's go back to the editor here. On this bullish one, let's forget about the bearish one. I just want to show you in theory it's possible to do the opposite of these. Let's talk about the bullish one. So you can do this checklist on any time you're looking at one of these cheap YOLO type stocks. Okay. You can say, okay, this thing is a bad stock. Am I going to get caught holding the bag? If you think you're going to get caught holding the bag, just stay away from it. If that's really a bad stock, don't do it. But if you want to roll the dice on it, you have several options. So let's do it like this. We're going to duplicate the tab. And we're going to duplicate this tab. Okay, so here's one option. Here's the most basic option. In option strat, you just hit add by qubit or whatever it's called. So you're buying shares, and then you just remove the options. Okay, that's one option. And then the other option is we're going to remove the puts. We aren't going to sell the puts. You don't have to do that. You don't have to do a risk reversal. There's nothing saying it's necessarily better. Sometimes you might just want to buy a call. So we'll look at that too. So we'll compare all three trades. What I do is in my head, I make sure that the three-legged strategy is the best strategy. It isn't always. In some situations, you might just want to buy the stock. It depends. Okay, so here's the profit and loss graph at expiration for the three-legged loaded dice. Okay, so here's just stock. Now let's just think about this. Okay, you have a 50% chance of profit. So, I could see this thing going to 7 or something. So, that'd be a $200 loss, $300 loss. I could also see it bouncing back to where the gap was. So if it went up, it'd be a $300 win. Okay, well, so this might be a good option if you wanted stock in this company for some reason, if you're trying to build a position in this. But I'm not trying to build a position in this. So stock's a 50-50 at best. I mean, I'm going to say no to the stock. So I'm going to X out of that window. Let's look at this is another decent option that a lot of people do. You don't have to sell something. There's, you don't always come out ahead selling options. You do lots of the times, and people like to sell them for strategic reasons, but you don't have to. So on this one, let's just try to make it even. If this one goes south on you, you're going to lose $400. So let's just buy, but okay, we're going to equalize it. This has a 62% chance of profit, but you're going to lose $400. So we're just going to assume you're going to lose the inverse of that. We're just going to assume you're going to lose 48% of, we're going to lose half of that. So to compare it on an even statistically, we could compare it with the $200 option position. So that's $84. That's $126, $168, $210. It's somewhat close. If this one goes south on you, you're going to lose $210. If the other one goes south on you, you're going to lose $400. But this one has twice as much chance of going south on you. So you bet half as much money. Does that make sense? Okay. Or it has more than twice as much chance. But anyway, so this is an apples to apples comparison, and a person could also do this. So what you would be sacrificing, you'd be sacrificing the income. On this one, you're going to get money up front, and you're going to get a higher chance of profit. Okay. And if you, of course, you just bought the stock, it'd be a 50-50 and no income up front. And if you bought the option, it's not even 50-50, it's only an 18% chance, and you have to pay money up front, which is part of the reason why it's only 18% chance. Now, but let's see though. Wonder if this thing goes to 20. Well, if this thing goes to 20, those options are worth $2,800. So if this thing goes to 20, on the max three-legged spread, the options are only worth $700. So, there's more upside in just the options. Now, let's talk about this though. Wonder if it goes to 14. The max strategy makes $84. The option strategy loses 210. Wonder if it goes to 12. So the max strategy does a lot better in the middle. Between 10 and 14, the max strategy does well. And that's the thickest part of the distribution curve. That's where it's pretty darn likely to end up. So anyway, that's kind of how I arrived at the strategy. I'm just trying to statistically move everything around. Now let's look how to do this. And let's say we wanted to do this trade. And I know you guys aren't interested in this trade. I just didn't like the bearish version of this trade. It didn't look like the risk reward was that much, but in theory we could do it. So let's just for fun, I'm obviously not going to do it. I looked at Petro Brazil. That's the one that was recommended. QUBT. It looks like refresh. Okay. So QUBT. So we're going out to next. To me, option strat is easier to demonstrate in, but we'll look at it in TastyTrade as well. I'm sorry this demo kind of went south. I was going to show how to do a short one, but I just didn't like that short example. We need a short one at a higher price. We need to find one that's 30, 40, 50 bucks that's really bad, that's going to zero, and we'll put one together on that. That one was too cheap, in my opinion. Okay, so it's bouncing. You can see on the chart over here, it bounced off 8. All right, so like I say, I'm sorry I'm not showing the bearish one. I just didn't like it. Okay, but to do a bullish one, here puts are over here on this side. So the at the money put, In TastyTrade, you click on the left column, which is the bid, which to indicate if you want to sell, and the right column if you want to buy. It says sell and buy right there. But so we are, we're selling this one, selling the 10, and then we bought the 5, and we're just going to test to make sure that it's giving us good prices on option strat. All right, and then we bought the 5, and then we turned around. What was that trade? Was it? I think we just turned around and bought the 15. So we go over here to the right column, but now remember, you have to click on, if you wanted to sell a call, we would click on this column, the sell, the bid. We want to buy this call. So this is our extra convexity, or this is our lotto ticket. We're spending 35 cents on this. Okay. So this gives us a 55% chance of probability of profit. We're capturing $105 of extrinsic premium. We have a 49% chance of profit of getting to 50% profit. That's how much theta decay we're earning every day. Not a whole lot. All right. So max profit's unlimited. I like that. Max loss is $395, and they're going to charge $395 of buying power. Now, they have something on here called curves. And it's good. I prefer to option strat. Anyway, but I just want to make sure the money and everything was right. So let's go back here to option strat. Okay, that's the bearish one. All right, and here's the bullish one. So it was actually the 14 strike call. And it was an $84 credit and a $400 loss. So I'm going to move this to so we had the 14.5. I'll select the 14. Okay. So then on the 14, it says here credit. And right now it's going for about $100 credit. Now, when you set your limit price, if that's the last price, I usually go to like 105. And even though it's at 98, and wait a minute, and then click it down to 102. And, it depends on what the market's doing. But anyway, I've tried to maybe get 100, put 102, and then it depends. But yeah, $400 to $2, you're going to get the credit, whatever you take for the limit. You can set your limit since there's basically no commissions. I think they charge, there's a, tiny fee or whatever, but you can basically set your limit. That's going to be close to what you take home. But now that's if it gets filled. Let's say you want 120, it's only trading at 93. You probably aren't going to get your 120. But if you put it on 100, it's trading at 93, it might click back and forward. And especially if the market rallies a little bit, it might come up and get your order. But in no case, since this is 3 legs, do you want to hit market. Just don't hit market. Always just look at what it's trading at, put it a few cents above, and then let it hit you. Like when it went down to 93, wonder if you would have put it at 98 or something, 96. And then now it's back up at 96. If it moves through to 98, then to $1, it'd probably pick up your order. Anyway, okay, so let's look over here. So yeah, $400 max loss, $84 credit. I didn't get quite as much credit as they're giving us on TastyTrade, but it's the same thing. Now, just to reiterate, here's the bearish trade. If you're bearish, you could do a similar trade. I mean, it'd be the similar risk, $400 risk, and you just don't want it to go up. And you make about 12% in 9 days. So it's not a terrible trade. Not a terrible trade. All right. So I think that's everything I wanted to cover. But another thing I was going to say is barchart.com is probably a good place to pick up bag holders. I'll try not to do content on things where we hold the bag, where you're going to end up holding the bag, but we don't always know in advance. And the way I do that strategy, where instead of actually buying shares, we're usually selling options. We try to do that so we can walk away with it from the trade with as little risk as possible. That's the whole idea behind that trade, but I still can't control what happens. Okay. So you can also, here's another way to get some decent ideas. You can look at earning stocks coming up. So we have JP Morgan, Goldman Sachs, and BlackRock. So I said I was going to show you guys how to do one of these on a legitimate company. Let's do one on JP Morgan. Okay. Let's just see what's going on here. Did I save this? Yeah, I did. Okay. JP Morgan. Okay. So where do we start? We start with a put, and we start with the sold put. So that should say -1 here. It says +1. Okay. Well, there we have it. And that we'll just start at the money. At the money is a good place to start. Okay. I mean, you could do a lot worse than just that trade by itself. You could do a lot worse than just that trade by itself. I mean, it's 66% chance of profit. You make $433 today, or you get $433 a day. You get to hang on to it as long as this thing doesn't drop more than 2%. Okay. But if it does, it's just like having stock. A sold put is basically the same thing as having, synthetically like having stock, except it's like having stock with no upside. So, but anyway, that's fine. So that's our start. So we always start there. Then step 2 is buy a put. I just go 5 strikes down. It doesn't matter. We can do 10 strikes down this time. That means the risk is going to be $1,000 less the credit. The credit's $300, so our risk is $700. Okay. And we have a buffer. We just don't want JP Morgan to drop more than 1.5%. The reason their IV is kind of high right now is because they have earnings in this week that we're talking about. It's only 31. It's not as high as the other stocks we were looking at, but it's kind of high for them. Okay, so then that's step 2. And now step 3 would be to add an out of the money call. And to put it right on that line right there. Yeah, okay. That's step 3. So that's just kind of the default trade right there. Make $196 credit as long as JP Morgan doesn't drop too far. If it does, you're going to lose $800. That's what it's the total amount you have a risk. But if something good happens and they trend up into earnings or something, you could make a lot more. That's not why you're doing this trade, but that right there, there's worse trades. So it's a chance of profit, 58%. So now from here, that's the base trade. So you're selling the one in the middle, you're selling this put, and you're buying the ones on the wing. You're buying this out of the money put, and then you're buying this out of the money call. That's the basic trade. Now from here, we could try to swing it a little bit by let's load the dice a little bit further. So I'm going to move the put down a little bit. And I'm hoping to move the odds up. Yeah, I've moved the odds up to 65, and I'll put a bigger buffer on it. Now it has a little bit bigger buffer. But sometimes you mess up your credit. This is $200 credit on $1,800 risk. It's about 1/9. I mean, I don't know if I didn't like it the first way more. But what I'm trying to show you is you can move it. However far you can move it, it behooves you to move it. When you do these little stocks that their IV is 797, you can move it a lot further. That's why these loaded dice trades probably work a lot better on the little stocks. But that's fine. We're still going to do the 3-point check and see if this is what we really want to do on JP Morgan. But let's just put together something so we have something to check. So we'll do okay. There we go. We're just going to do the base one on JP Morgan. It's not the worst trade. I mean, you get $200, $250. Take your wife to dinner tonight, risking $1,000. It's going to tie up $1,000 out of your account. But just if you're bullish on JP Morgan, this is one way to express it. Okay, so or bullish on their earnings or bullish on the market or whatever. So let's save this trade. And this is loaded dice. I should have said bullish loaded dice. But anyway, so we're going to save this trade. back to editor. Then we're going to duplicate this tab, and we're going to look at our two other options. We don't ever have to do anything, but let's look at two other ways to maybe play JP Morgan's earnings. There's a lot more ways than that, but let's just look at two direct ways to compare. So the first direct way to compare is just to buy stock. And I could do it in here, but you guys know. So stock is going to be 50-50. Our risk is down to zero. And it's going to tie up $24,000, $25,000, something like that. Okay, well, that's fine. That might be a better option. If you want JP Morgan stock, if you're trying to build a position, that could be a better option. But I'm going to say no on that one for me. And I know I didn't duplicate it, but then let's duplicate let's just remove the puts and just look at buying the call. Now the call by itself only costs $98, so we could buy probably two or three of them cost about what you made, about the credit that you got to take your wife to dinner if you did the other strategy. So we'll just say two. We'll say two. This is instead of taking your wife to dinner, you said, no, we aren't going to dinner. I'm going to spend a couple $100 on JPM calls. You could do that as well. So let's see what you would do. Now you'd only have a 14% chance of profit with JPM, and your chance of profit with your wife, or chance of success with your wife, would even be less, I would probably say, if you told her you were choosing JP Morgan calls over her. So I would probably do it the other way, risk a little bit more money, but you still have some good upside. The problem with this method is you don't really cash in until like 260. You don't get any kind of appreciable income on this one, depending on when it gets there. At 260, you're doing pretty good. You have $1,000, but you can also make 320 at 250. The other one, you aren't going to make any money at 250. Okay. So for me, which one I'm going to say. I like the other one, but in some cases, you could also make a case for this one. So, like I say, I'm trying to teach you guys how to do these trades and why you would want to, and when you do want to, and when you don't want to, because that's the thing. Now, here's one other thing. On the tiny stock, the quantum stock, the bearish three-legged didn't really work that well, just because it was too close to zero already. A bearish three-legged on a blue chip can work really well. If somebody was bearish on JP Morgan earnings, we do the same thing. Well, watch this. All I'm going to do is I'm going to hit switch to call. I'm going to switch them all to the opposite. Switch to put. Then I'm going to switch this one to call. It's the opposite trade. It's basically the opposite trade. So where do we start? If it's bearish, we start with selling a call at the money. Then we buy a call out of the money so we don't lose too much if the stock should go up. That's a 10-point spread, so we're risking $1,000 less the credit, which is $365, so about $600. And then from there, we could go to buy put. Out of the money put. Let me move this till expiration. Same thing applies. I want to start making more money at the right here, as close as possible to the center line. Okay, so the $260 credit on $730 worth of risk. You just don't want JP Morgan to move up more than 1%. I mean, this isn't the worst way to make a bearish bet on JP Morgan if you wanted to make a bearish bet. Once again, though, look at this and then look at just shorting the stock. Okay, well, you short the stock. It's 50-50 chance. You're You have unlimited loss on the upside. Some stocks are hard to short, especially those little ones. It's hard to do. So there's all kinds of reasons why I think shorting the stock's not a good idea. So I'm going to say no to that one. But we have to ask ourselves on every one of these, even the ones I tell you about, and I say it looks like a good play. Well, I'm just talking about math. You can look at it and you can say, well, yeah, I don't know. Maybe the put by itself is a good play. And sometimes the put by itself is a better play, to sacrifice all that profit and potential, but to save yourself a little money on the front end. I mean, the other one is a credit, but let's make them equal. So yeah, I think the credit was 270 or something. So you could spend a debit and do kind of the opposite trade. Just buy the darn put. And there's nothing wrong with this. If you know something, especially if you know something about JP Morgan. And I definitely think this is a better thing to do than just shorting the stock, in my opinion. And I really think that all three together is better than either shorting the stock or buying that out of the money call. I think this is not a bad way to express a bullish opinion. You just want prices to be steadier or lower. If we have a crash, that's okay too. You have a built-in lotto ticket. We don't think that's going to happen, but that's one of the nice things about these trades. All right, so now you've got a pretty good idea. We've done a bearish JP Morgan. We've done a bullish JP Morgan. I just want to make sure everyone understands the bullish loaded dice, the ins and outs, and where you start. There's lots of times, just because here's the thing, in options with commissions being free, just about anything works in theory. So people like me can put lots of stuff together in theory. That you still make the real money in real life. You either make or lose money in real life. So just because of an idea, just because you can do something doesn't mean you should do it. Is what I was trying to say. I personally, for me and myself, I do like these three-legged spreads because I like extra upside, and it gives me a good mix of income and upside. And my results have been a lot better in the 3 months that I've been doing them. They seem better, but I had some big losers. I mean, MongoDB put the hurt to me. So I don't know. Anyway, I just thought you guys might want to know. So what I want to do now is maybe I could do a live in Discord and you guys could ask me questions, because I'm sure that there's still tons of questions and tons of stuff I either went too fast on or didn't explain correctly. But hopefully that's a pretty thorough. There's some good examples in there. So let's go over our examples again. This is one not to do. I just don't like that. I could show you a better way to do that, but I just don't want to confuse it for now. So that's not a great trade. For bearish on the market or something, maybe do a bearish JP Morgan trade. Especially if we have $800, we can risk. Want to make sure we're prepared for the worst case scenario. For bullish on JP Morgan, that's not the worst trade, but I don't like it as much as the other one I showed you. And here is the other one I showed you. All right, that's really the best one of the bunch, just mathematically. Well, you get 25% income right away, plus you have a pretty good sized buffer. It all depends on what JP. Here's my other theory. JP Morgan's going to do whatever JP Morgan's going to do. You can either do nothing. In the old days, you could do nothing. You could go long. You could go short. Nowadays, you have more choices, but you could still do nothing. You don't have to do anything. What I like is you can do this and you can still make money if the stock does nothing. That's the whole idea. If the stock moves up, 1.4%, you make $150. And if, gosh forbid, if you should get a 2 standard deviation move or something, you can actually make a pretty decent return. So, all right, guys. Well, I'll let you go. I appreciate y'all. You have a good day.